Now tell me you're bearish on US stocks without telling me you're bearish on US stocks. Let me start. I'll go here. Abu Dhabi's Royals firm shorts US stocks on global recession fears. Well, clearly someone's really bearish on the US outlook. And clearly it's Abu Dhabi's royal firm who's shorting, not with just a couple dollars and just, getting fancy here, but shorting with billions and billions of dollars. Now, before I get into this article that comes out from Bloomberg, my name is Daniel. I run Infovest. Infovest is an organization that promotes financial literacy and teaches you about macroeconomics and tries to relate it all to the financial markets. And just kind of giving you my take on where all of these things are going. You can definitely subscribe to continue to be updated on the content, or you can visit our website, which is inforvesting.com, to learn more about our macro investing courses there. Now let's get into the article. The article starts off saying an investment firm controlled by the top Abu Dhabi royal has built a short position worth billions of dollars in US stocks. People familiar with the matter, in a bet that growing fears over a recession will pressure markets. The Royal Group turned more negative on equities at the start of the year. So they were already negative, but turned even more at the start of the year, and has shifted more of its portfolio into short-term US treasuries. And also later in this paragraph, it also talks about that the chair who's running the firm is also investing in commodities and crypto as well. So first of all, being very negative on the equity markets, especially the start of the year, is very interesting because the start of the year we had the complete opposite. We had a rally in the stock markets. The markets went up. And everyone was predicting and pricing in or actually expecting that the stock market was going to crash in this year, the start of the year, which I disagreed with, and I didn't quite understand why it would do it in that first quarter. And you could see here, this royal group probably thought the same way, that, okay, maybe we might get some sort of crash in the first quarter, but that did not happen. And generally, markets are so interesting that it tends to work that way. It tends to not give you what you want when you want it, right? And that's the beauty of the markets. And the fact that everybody was massively bearish just simply caused a massive rally in the equity markets. Now, this bearish vibe, you could argue, somewhat has subsided. Somewhat, right? If you just look at the equity markets, you can hear people saying that, hey, this time is different, the markets are not crashing, look at the growth data, the jobs data, etc., etc. Hey, there's evidence that inflation's slowing down and the growth is so strong. So guess what? It looks like that Jerome Powell is doing a good job and is right that, hey, we're probably not going to see a recession. And if we do, it's going to be a mild recession. Now, what does a mild recession mean? Well, it could mean what it means, which is it's not going to be that bad. But generally, whenever they price in, the Fed prices in a mild recession, it generally tends not to be that. Like I was saying before, the economy and the markets, most importantly, generally doesn't give what everybody is expecting whatever anyone's expecting to get from the markets. It usually happens in the opposite way, which we saw in the beginning of this quarter. Now, another interesting thing is that the Royal Group is also heavily invested in U.S. Treasuries, bonds. Sure, I mean, why not? Short duration, you can end up in having a very good yield with billions of dollars. But there's also another telling sign there as well. And we've seen this previously in the past recessions, especially before the 2008 crash, where you tend to see foreign investors pile into, and they tend to pile in early. That's the thing. They tend to pile in early into US Treasuries when they see a lot of recession risk and demand of really deteriorating. And we're seeing that exactly in this article where it says that a lot of the money has been shifted in this Royal Group's portfolio into these US Treasuries. So right here and there, you're seeing a lot of signs of deterioration in the economy, recession talks, and you're seeing flows of money move into treasuries, betting that, yes, the U.S. market and the economy is bound to deteriorate. But where is it, right? You might be asking, Daniel, where is it? Everyone was saying Q1 it was going to happen. You know, where is it? Why is it not? Why nothing is going wrong, right? And also another thing, you'll be hearing a lot of people talk about, look, inflation's coming down and the job market's still strong. It's robust and the unemployment rate is, all-time lows. Where's the recession, Daniel? Where's the recession? Remember what I said in the beginning of the video? It doesn't happen the way you want it to happen. It'll never, ever, ever happen the way you want it to happen and when you want it to happen. It happens when you least expect it. Simple as that. What does that mean? That could mean that the S&P 500 maybe rallies more. It reaches closer to all-time highs and inches closer, or maybe makes all-time highs, or the Dow makes all-time highs. And the narrative comes out like, look, we're winning on inflation, or inflation has stabilized. It's sticky. It's not even though it's maybe not coming down, but not going up. We've won, and things start to go up. And when the fear is out, then guess what? That's when you least expect it, because that's when the panic happens. When does panic actually happen? Panics happen when you're not prepared for it. Everybody's prepared for it. Everybody's short. Everybody's bearish. We have to, the markets did already, but it may do it some more. But we have to get out all those bearish positions, those shorts out. And then, yes, you can get panic, because if everybody reverses back into going long and being bullish, and they buy, at elevated prices, and they see things turn around very fast, very quickly, then you get a domino effect of panic after panic after panic, and the markets sell off, and then you get that recession or crash. So until then, we'll just have to wait and see, and we'll have to wait and see how these royal firms and many other key players out there that are investing in U.S. Treasuries and shorting U.S. stocks, betting against the economy, we'll have to see how that plays out. And it could be a dangerous trade also, with billions of dollars invested in shorting. It could be dangerous too, because that can also pose a squeeze in the market. What is a squeeze? Well, a squeeze happens when you have a lot of traders who are short, and especially big traders who are short, and markets don't go down, but they go the opposite way and causes a short covering rally, which ends up adding more fuel to the fire and pushing equity prices higher. We saw that with the U.S. bond market. U.S. bond market had a massive squeeze on the regional bank failures. When the regional bank failures started with the Silicon Valley Bank, you had a lot of hedge funds and firms short U.S. bonds, and within a day, overnight, they had to get out of the short positions in billions of dollars that caused U.S. bonds to literally go right up. And that was because many of them blew up. Many of them lost a lot of money on that squeeze. Can we see the same thing in the equity markets? Sure. Can we see volatility come back in? Sure. Can we see optimism come back in? Sure. And then maybe that would be the setup for the next shoe to drop and the panic. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, good luck, bye.